Hi, this is Rowland for Money Markets TV. Last week, I pointed out how overbought and speculative the rally in silver prices was, just ahead of a major crash in that market and the ETFs that track it. I hope you were able to avoid all the fireworks, but the 4-day slide offers a good opportunity to look at how ETFs behave in fast-moving markets. During the decline, more than a few investors didn't get what they were expecting, and that's mainly due to the popularity of leverage and inverse ETFs and misunderstanding how they work. Leverage is nothing new. Stock traders have been trading on margin with borrowed money for centuries. The results can be good or bad. Leverage is simply a tool. What matters is how you use it. Nowadays, a lot of mutual funds and ETFs offer this capability, in some cases up to 3 times daily leverage. But the key word is daily. Leveraged mutual funds and ETFs typically reset their leverage factors every market day. That keeps investors from suffering a total loss or even more, something that can and does happen to people who trade on margin. Leveraged ETF managers generally do a good job at tracking their benchmarks closely. Unfortunately, many investors don't quite grasp what this really means. They buy leveraged ETFs without knowing how a daily leverage reset can affect their returns over longer periods. They just think, if my benchmark index goes up 20% in a week, then my 2 times leveraged ETF will make 40%. In fact, if your selected market has a 20% weekly gain, a 2 times leveraged ETF could rise much more than 40% or much less. It all depends on the daily results. We can see exactly how this works by looking at 3 ETFs that track the silver market and how they performed last week. Silver bullion fell nearly 30% over a 4-day period, and the iShares Silver ETF, ticker symbol SLV, saw a similar decline, down just over 28%. Based on that 28% drop, you might expect that ProShares Ultra Silver, ticker symbol AGQ, tumbled 56% last week, since it's designed to deliver 2 times the daily change in silver bullion. But in actuality, it fell just 50%, because its percentage decline was based on the daily changes in silver prices, not the weekly change. In the same vein, let's look at the performance of ProShares Ultra Short Silver, ticker symbol ZSL. It's an inverse leveraged silver ETF, AGQ in reverse. But instead of gaining 50 or even 56% over the 4-day silver crash, it actually surged more than 78%. My point is that these types of ETFs reset their leverage factor every day, so their results can be counterintuitive and surprising. ZSL was not a 2 times inverse ETF last week. It was closer to 3 times. Yes, it worked to the investor's benefit, but it could have easily gone the other way. This variance isn't necessarily a reason to avoid leveraged ETFs. It just means you need to understand how they work and what to expect. These instruments are really intended for short-term trading. They don't work so well over longer periods, unless the daily moves continually work in your favor. Now, I've written a lot about leveraged ETFs and inverse ETFs in my past Money and Markets columns. If you're interested in them, you'd be wise to read up, because it's better to know what you're getting into than to learn about it the hard way. I'm Rowland for Money and Markets TV. Thank you for watching.